one presentation that you did recently, and I know you can talk for a long time on this, so I'll actually just maybe to give us a slightly more concise version, although it is fascinating. And the presentation you did was on investing in a world of populism. Can you explain the concept and some of the implications and how you manage it?
Yeah, I think populism for us is, if you think back to the early 80s, I'll keep it concise.
Yeah.
Inflation, you had, inflation, the Fed started to get serious about controlling inflation.
Yep.
And, and hence we've had a bull market, which is sort of in some ways still going. And what we all got programmed, I think, over that period of time to ignore politics. Ignore just ignore politics and ignore even global risk events. I wonder if things are changing just now. And I think it's mainly changing because politicians realise that leverage, we've probably reached the end of the road in terms of leverage at a very high level.
Yeah.
I'm not saying that there are not sort of assets that can't sustain more leverage, but at a high level, if we just thought about government balance sheets, household balance sheets, and corporate balance sheets. So what do you do next? In the next downturn, what asset are we going to leverage to create the economic activity? I don't think we are. I think we're going to create inflation. And I think we're moving to a world where governments will use the fiscal lever aggressively, and central banks will monetize it. Right. And now you can say, haven't we been living through that at the moment? Well, maybe, but most of the QE has just ended up in excess reserves in the banking system. You could argue that it's held down government bond, it's held down interest rates, and it's allowed the US to borrow and cheaply and fund its fiscal 3.5% fiscal deficit, never seen before in a time of outside of a time of recession or war. But that fiscal deficit in the US, I think, reflects populism, polarization, the fact that there's no middle ground. Now that's somewhat unique to the US electoral system, which has been systematically gerrymandered. So you're either extreme blue or extreme red, and the election gets decided by 3-4 swing states. That's US politics, but that's somewhat global politics now. And fiscal excesses are coming, and we've had it in the US. I think it's probably coming in Europe, and markets aren't really thinking about the longer term implications.
And so one of the things that struck me from your presentation was we've become used to this idea of globalization, and this might almost be an opportunity for that to reverse. How do you think about that?
I think it is reversing. I think we are going to that sort of more almost multipolar type environment. I think you'll have Asia, sort of more of an Asia economic bloc anchored by China. Then you got the US and sort of China, Russia together maybe, and US and Europe, or US seems to just want to go it alone at the moment.
Yeah.
But I think governments, as they become concerned about growth and this whole idea of tariffs, it's about trying to bring activity back home, right? And the Europeans are starting to, are floating this idea of a carbon tariff, which would obviously be a tariff on China. So it's all part of this, I think, populism and how globalization kind of made sense to the extent that you were accessing cheaper labour markets. But there was a point, I think, where it went from being a sort of a free market concept to being this sort of capitalist capitalist concept, because maybe the benefits of globalization have not been shared particularly well, and so social cohesion starting to fray, and it's a bit sad that gets blamed on, because insularity won't lead to a better outcome, I don't think.
No.
Necessarily, and the laws of comparative advantage mean you stick to what you're good at, right? And tariffs don't help that. It's unfortunate because, and I think it's magnifying the current cyclical slowdown we're seeing. Is just there's so much corporate uncertainty around trade and supply chains and where to invest, and it's affecting the credit multiplier. We've got very cheap interest rates. Is it who's borrowing? And I think that's an interesting question.
Perhaps we can talk now, as we come to the end of this, is just how you're investing on the back of this. And I've heard you say before that you're almost avoiding domestic US. You're seeing excesses in things like venture capital, and we see unicorns, those types of things these days. So, and then another thing you mentioned is the impact that low rates are having on the slower growth businesses in the US, or businesses that should be investing perhaps. So perhaps you can just flesh that out for us and how that ties into your early beliefs.
I think a good example is US domestic. When we say domestic, we're really talking about companies that are not competing globally, they're competing locally, like retailers. Look, you think about all the retailers that are caught between Amazon and Walmart, and Amazon pushing as it gets closer to the customer with one-day delivery, pushing into lower margin areas, groceries, Walmart wanting to maintain its dominance in groceries, giving free delivery, every way you look at it, if you swing into a Walmart and someone's gone around and picked up all your groceries for you, or even if you don't pick them up but they get delivered, I mean, that's a lower margin business, all right, to you, self-service. Walmart has the financial they have the financial resources to subsidize that activity because they want to win, and they can win. They have to win. I don't know. I'm thinking about Kroger, and you think about some of these companies that, number one, they've bought back a lot of stock, so they have a lot of leverage. Can they actually sustain that competitive fight with Walmart, strong incumbent on one hand, and sort of Amazon, a strong disruptor on the other hand? That's what we see in lots of different industries in domestic US. Too much leverage in some of the weaker incumbents under competitive threat from disruptive new entrants and other strong incumbents. And the credit markets have facilitated that. The Fed has facilitated that. So we're living through one of the most vibrant periods of technological disruption. No one's going broke. It doesn't gel, right? Like if the disruption is successful, but the cost is being, at the moment, it's being somewhat papered over by very forgiving credit markets. I think that's a fairly toxic mix at some point in time. The Fed, commentators have often said that the Fed doesn't want the US to become Japan, i.e. enter a period of sustained deflation. It's almost guaranteed to happen if you keep running super loose monetary policy globally, because central banks are basically underwriting very forgiving credit markets, which are then bailing out the wrong companies. The weaker companies are the ones who are borrowing. And look, I think similar to what we saw in subprime, that can end very, very badly. But it might go on for. So how do we position the portfolio in that environment? I think be careful about when you're buying. We've got a cluster of cyclical businesses, industrial businesses, which we think are actually growing in a secular sense. So
Okay.
the two big ones, Siemens, GE. Siemens, it's the more cyclical parts of it are really couldn't be better. If you thought European stimulus, infrastructure stimulus was coming, as we do, Siemens is the ready-made stock.
Mm-hmm.
Now, the great thing is you don't need that to happen because of how the company's priced today. But secondly, it has this secular growth part of the business, digital factory, which is very software-centric business. They have a business called Mentor Graphics, which competes against Altium. And, your listeners will know Altium. It's one of the most highly rated local stocks. Well, Siemens has a big Altium embedded in it, but it goes way beyond designing the semiconductor. It designs the entire manufacturing process, and then it also implements it. So you can imagine the kind of lock. You've got companies like, Daimler, Mercedes, you've got Boeing using their software, and it's hardware as well. So you've got the full package. You buy that stock on 13 times. That's to me very, very interesting. GE, higher multiple, but you've got the world's best aerospace business. In both companies, you've got great healthcare exposures. Look for quality and growth in less obvious parts of the market. In the drug companies. Longs and shorts, but Merck for us is a great long story. The Keytruda hit a home run in immuno-oncology with Keytruda, but at the early innings of actually harvesting all of that R&D and building out the sales force, and we think they'll be able to bring that what is a late stage treatment for cancer into early stage with significant increase in the addressable market. You've got a business that hasn't been gouging its patients in the US. So even if politicians focus on drug prices, which we think they will, Merck is nowhere near the top of their list in terms of serial offenders. By the way, I can't think of a sector today that doesn't have significant political risk in some form. So the idea that it's clearly coming for big tech. It's coming, it's always been there in financial services. It's always been there in healthcare. So it's a question of knowing where, to a certain extent, where the risks actually lie in terms of specific companies. Look, I think you can make technology still interesting. We're living in a world of serial disruption. It's thinking about where maybe what you should pay for a company. If you think about where Microsoft is, I think it's absolutely in the sweet spot. It's the Azure platform business is basically just harvesting customers off their existing servers. They're switching off support for a bunch of different Windows and Office products, which will simply mean that Office, they'll get converted to Azure and then to Office 365. And then you think about what Office 365 can become longer term, as they add, continue to build out the offering. And what you may be able to ultimately charge for a very integrated bundle versus the best of breed SaaS offering, And I think the best of breed SaaS offering has been where all the excitement, that's where all the nosebleed multiples really are. I think, Microsoft to a lesser extent, Google, but probably also Amazon. I was going to say Oracle, but are all sort of starting to flex, I think, their muscles and think, well, we can push into some of these other, we've got a great platform. Let's just keep going horizontal to get as much of the customer wallet as we possibly can. So looks expensive. Some value investors might say, oh, Microsoft, how can you own that? It's growing now at a faster rate than it's grown for a long time. And I think it's still a reasonable multiple for the quality of business. Now, I can't say that for all of the FANGs, but we don't all own all of them. You know, we own Microsoft and we own Facebook.
Okay.
Yeah. So look, interesting opportunities out there. You need to be, I think you've got to have some cyclicality, but look for the structural growers there. Cyclicals are cheap. Be careful around the growth at any price, especially the ones that are weaker business models. And just be open to the idea that the US economic cycle is, it's pretty long in the tooth. Really, for the big discount that you have ex-US, all you need to see is that the rest of the world catches up. If that divergence between US growth and rest of world growth doesn't grow, you'll be making more money in European banks than you will in US banks, just because of the starting multiple.